K Limited and L Limited amalgamate to form a new company, LK Limited. The financial position of these companies on the date of amalgamation was as under. For K and L, we are given the share capital. They are saying equity shares of rupees 100 each. So shares are of 100 each. That means there are 8,000 shares over here and there are 3,000 shares over here. Okay. Preference shares are also of rupees 100 each. That means there are 4,000 shares here and 3,000 shares over here. Debentures are there only in K, general reserve only in L, P&L, trade payable, secured loan only in L. Goodwill only for K Limited. Land and building, plant and machinery, furniture and fittings, trade receivables, stores and inventory, cash at bank, cash in hand. Yes, it's a pretty detailed balance sheet which they have given to us. Okay, what are the terms of the amalgamation? Assumption of liabilities of both the companies, fine. Then they are saying issue of 5 preference shares of rupees 20 each in LK at the rate rupees 18 paid up at premium of 4 per share for each preference share held in both the companies. Okay. So they are saying issue of 5 preference shares of rupees 20 each. So 20 seems to be the value of the preference share. And they are saying 18 paid up at a premium of rupees 4 per share. So 18 plus 4. So the value of one preference share has been considered to be rupees 22. Okay. And they are saying issue of 5, and then they use the word each. So 5:1 is the exchange ratio for preference shares. Issue of 6, the third information, issue of 6 equity shares of rupees 20 each, 18 paid up at a premium of rupees 4. So again, it is 18 plus 4. So the issue price is considered to be 22. And they are saying 6 equity shares for each equity share. So 6:1 is the share exchange ratio for equity shares. In addition, they are saying necessary cash shall be paid. They say necessary cash shall be paid, and this cash will be paid only to equity shareholders of both the companies, as is required to adjust the rights of the shareholders of both the companies in accordance with the intrinsic value of the shares. Okay. So whatever is the total value of the shares, necessary cash will be paid to the equity shareholders. So what this means is we will have to first find out that what is the total net assets that we are going to transfer. Okay, so we will have to find out what is the total value of the net assets. From that, we will deduct what we are paying to the preference shareholders. From that, we will further deduct what we are paying to the equity shareholders in form of shares. And if there is still something extra left, that you have to adjust in cash. So that will be one important working note in this particular question. In information 4, they are saying issue of such amount of fully paid 6% debentures in LK Limited as a sufficient to discharge the 5% debentures in K at a discount of 5% after the takeover. So this is information about how we will settle the debenture holders. But we know purchase consideration is comprising only of what we pay to equity shareholders and what we pay to the preference shareholders. In B, they are saying the assets and liabilities are to be taken over at the book values, inventory and trade receivables for which provision at 2% and 2.5% are to be raised. So yes, book value of the inventory I'll have to reduce by 2%, and trade receivables we will be reducing by 2.5%. And then they say the trade receivables of K Limited include 20,000 due from L. Fine. They are saying LK Limited is to issue 15,000 new shares of rupees 20 each, rupees 18 paid up at premium of 4, so as to have sufficient working capital. Right? This is going to be done by LK Limited. But if you see the question, they are saying prepare ledger accounts in the books of K Limited and L Limited to close their books. So we are simply supposed to prepare ledger accounts in the books of K and L. So since we have to prepare ledger for K and L, We don't have to do anything for information C because this accounting entry will be recorded in the books of LK. Well, we have to simply prepare the ledger of K and L. Okay. So the important working note that we have to really prepare over here is with respect to the cash that we will have to pay. So we work out what is the intrinsic value, and based on that, find out what is the cash that will be payable. We say determination of cash payable to equity shareholders. So what we will do is we'll make a list of the assets and the liabilities and work out the net assets. If there is adjustment, if there is any adjustment to be made in the value of the assets or the liabilities, we will definitely make that. So I'm just copying from the balance sheet. I have kept that purposefully on my side. You can also do the same. So goodwill, land and building, plant and machinery, furniture and fittings, yes, be careful now, trade receivables. We will reduce it by 2.5% as demanded by the question. They've written stores and inventory. I'm writing simply inventory. Inventory is to be reduced by 2%. So we have been able to prepare a list of the assets. Let's take a total. From this, we will deduct the liabilities. So I get 15,60,000, 7,90,000. This 15,60,000 and 7,90,000, that is turning out to be the intrinsic value of the net assets. By intrinsic value, we mean that if this company is going into liquidation, actually both the companies are going into liquidation, this is the total value that belongs to the shareholders. If you see on the liability side, we have equity share capital as well as preference share capital. That means whatever answer you are getting right now, 15 lakh 60 and 7 lakh 90, this belongs to the shareholders, right? This is what they should minimum of minimum get. If they are getting more than this, it is fine, but this is what they should minimum of minimum get. Otherwise, the shareholders will be at a loss. But our intention of doing this working is to get the cash payable to the equity shareholders. So from this, we should now deduct what we are going to pay to the preference shareholders. So we say less payment to preference shareholders. We will work out what we are giving to the preference shareholders. Okay. So we read information for preference shareholders now. Right, 4,000 preference shares are there in K and 3,000 preference shares in L. And if you see information 2, our share exchange ratio is 5:1 and we are ready to issue shares at 22. Okay, so that is how we will settle this particular matter. So 4,000 preference shares are there here into 5/1. So that is 20,000. And we will issue shares at 22. How am I getting 22? 18 plus 4. That's my agreed issue price. So this is giving me 4,40,000. The other company has 3,000 preference shares into 5/1. So 15,000 preference shares and our agreed value is 22. So 15,000 at 22, that is giving me 3,30,000. So this is how I settle the preference shareholders. Okay. So the total money due to the shareholders is 15 lakh 60. Out of that 4 lakh 40 I give by way of preference shares. 7 lakh 90 is there for the other company. I give 3 lakh 30,000 to the preference shareholders. I'll further continue. I'll say less payment to equity shareholders. Right, we are going to give shares even to the equity shareholders. Sorry for that. Yes, I return back to the question 8,000 and 3,000 and 6:1. Okay, okay, okay. So 8,000 shares here into 6/1. That's the share exchange ratio. I'll give them 48,000 shares at 22. That is 10 lakh 56,000. The other company has 3,000 equity shares into 6/1. So 18,000 shares will be issued, 22. That is turning out to be 3,96,000. Whatever is left, that is going to be our answer. Cash payable to equity shareholders. Okay. Cash payable to equity shareholders. Work out the difference. It turns out to be 64,000. That's our work. I'll give you a full view of the working now. This is the place where, if necessary, you may pause the video. If you have missed out anything over here, pause the video, complete it. Yes, this is the further working which is there. preference shareholders over here. Payment to the equity shareholders over here. Right. Now, what is an interesting thing is you are paying this to the preference shareholders, right? And this 10 lakh 56, 3 lakh 96, sorry. This 10 lakh 56 you are giving to equity shareholders. This is also equity shareholders. This is also equity. This is also equity. We know purchase consideration is what you pay to equity shareholders and preference shareholders. In a way, I can say that this itself is the purchase consideration. Do you get my point? 15 lakh 60 and 7 lakh 90 is purchase consideration, and what I'm showing under it is the settlement or the discharge of purchase consideration. So a separate working for purchase consideration is not necessary over here, because whatever I will pay to preference shareholders plus whatever I pay to equity shareholders, that sum total itself is purchase consideration. So 15 lakh 60 and 7 lakh 90 can be treated as the purchase consideration. So that is what gives us the purchase consideration as well as its discharge. So what exactly is the question? We are supposed to prepare ledger accounts. Now we want to close the books of both the companies. Now if you just see the asset side, there are such a large number of assets given. Now if I have to close the books, then I will have to prepare an account for every asset which is there and every liability which is there, and I have to do this in books of both the companies. So what we will do is we will prepare only the important accounts. Okay, we will not open account for every asset and every liability. We will rather open realization account. We will open the purchasing company's account, and of course the preference shareholders and the equity shareholders account, so that we can settle the shareholders and thereby close the books. Getting it? So that is what our plan is. Let's prepare the necessary accounts. We say in books of A Limited. You open realization account. Start with the realization account. We know the very first thing that we will do is in K Limited, whatever assets are there, right? Whatever assets are there, all these assets will be transferred to realization. And remember one thing, whenever you are recording the accounting entry in the books of the selling company, it has to be compulsory at book value. Okay. So as we know, we had reduced the trade receivables by 2.5%. We had reduced the inventories by 2%. But when we transfer to realization, we will not give any effect. That reduction was outside the books. Okay, I wanted to find out what is the real value of my assets. That is the reason I reduced it by 2.5% and 2%. But when I will record accounting entries, it has to be compulsory at the book value. Any reduction is there, all that will be captured in the closing balance of the realization. You get my point? So please do not disturb the figures of the assets in the realization. It has to be compulsory at book value. Again, I will repeat, the reduction of 2.5% and 2% was done outside the books only for the purpose of finding out that what is the real value of the asset. As far as my accounting entries are considered, it will happen at the book values only. So I will transfer all the assets to the realization. My accounting entry will be realization account debit to the different assets, isn't it? So realization account debit. So I say to goodwill account, right? Start transferring the accounts to goodwill account, 80,000, to land and building account, 4,50,000, to plant and machinery account. It's a very elaborate question. To plant and machinery account, 6,20,000, to furniture and fittings account, 60,000, to trade receivables. Be careful, do not disturb the value. Trade receivables, 2,75,000, to inventories, right? I'm writing in short. To inventories, 225, right? 225. To cash at bank, 1,20,000. To cash in hand, 41,375. That is it. Okay. Similarly, the liabilities will be transferred to realization. Liabilities account debit to realization. So by debentures account, 2 lakhs. By trade payables account, 1 lakh. These are the only two liabilities in the books of K. So I have transferred the assets to the realization. I have transferred the liabilities to the realization. My third accounting entry will be for purchase consideration due. Purchasing company account debit to realization. Purchasing company is LK. Purchasing company account debit to realization. I'm crediting the realization by LK Limited account. Purchase consideration is 15,60,000. Isn't it 15,60,000? So yes, I will need a new account to be prepared. LK Limited account. Okay, LK Limited account. I'll say to realization account, 15,60,000. My next accounting entry will be for settlement of the purchase consideration. So LK Limited is going to give us cash, is going to give us equity shares. So cash account debit, equity shares debit, preference shares debit to LK. So by cash account, 64,000. By preference shares in LK Limited account, 4,40,000. By equity shares in LK Limited account, 10,56,000. In a way, this closes the account itself, right? The account gets closed. 15,60,000 was due. 15,60,000 is now settled. Great. Need to prepare the shareholders accounts now. So preference shareholders account. Preference share capital will be transferred here. So my accounting entry will be preference share capital account debit to preference shareholders. Preference shareholders are credited. So by preference share capital account, 4 lakhs. We are giving them preference shares. So preference shareholders account debit 2, right? We will give them preference shares now in the purchasing company. So preference shares in LK Limited account. We give them preference shares worth 4 lakh 40. We are giving them preference shares of 40,000 rupees extra. This extra will be transferred to realization. So we say to realization account 40,000, right? So the account gets closed 440, 440. This 40,000 I'll take to the realization. So in realization, I say to preference shareholders account this extra 40,000. Great. Finally, I need to prepare the equity shareholders account. Equity shareholders account. So let's prepare the equity shareholders account. We will show here equity share capital. Equity share capital is 8 lakhs. P&L that also belongs to the equity shareholders 371,375. Okay. I need to close the realization now. The realization account needs to be closed. So let's take a total here. It is 1911,375. I put it here 1911,375. I get a difference of 51,375. This goes to the equity shareholders. Right, there is a loss on realization which belongs to the equity shareholders. So I say to realization account 51,375. We give them equity shares in LK Limited account 10 lakh 56. We also give them cash 64. If everything is correct, the two totals will match. This closes the books of K Limited. Books of K Limited are closed. Yeah, if anything needs to be paused, you can do that now. This is realization account. Anything pending here, pause the video here, complete realization. Yes, anything pending for LK Limited and preference shareholders, pause the video here. And of course, equity shareholders account. Anything pending here, close the video here. It's now time to close the books of L Limited. Realization account. Right, the method to be followed has now become clear. what is needed to be done has become clear. So start transferring the assets to realization, to land and building. Relax. There's no goodwill here. Plant and machinery, 5 lakhs. To furniture and fittings, to trade receivables, do not disturb the amount. We have already discussed that. Everything in the books of the selling company at book values. Do inventories, do not disturb this. Basically, the entire asset side is to be copied over here. Okay. Entire asset side is getting copied over here. Time to transfer the liabilities. No debentures over here. There's a new one, secured loan. So we have transferred the assets and the liabilities to realization. Step 1, step 2 completed. Okay. Step 1, step 2 completed. The next accounting entry is for purchase consideration due. LK Limited account, debit to realization. Realization is credited. So by LK Limited account, 7,90,000. That itself will give rise to the new account now. LK Limited account. Okay. To realization account, 7,90,000. Settle it. Cash, 64. Preference shares in LK Limited, 3,30,000. And LK is also giving equity shares in LK, 396. Purchase consideration due, purchase consideration settled. Right. Time to take care of the shareholders now. Time to take care of the shareholders. Preference shareholders account. Preference share capital account, debit to preference shareholders. Preference shareholders is credited, so preference share capital. Relax. Settle them, give them preference shares of the purchasing company. So 2 preference shares in LK Limited. It's worth 330. Extra 30,000, debit the realization for it. Anything extra that you are paying to the preference shareholders is at the cost of the equity shareholders. Equity shareholders lose out because of that. To preference shareholders account, 30,000. Right. And the final one, equity shareholders account. Equity shareholders account. Yes. Money due to them in form of equity share capital, 3 lakhs. This time some general reserve is there. So general reserve, 1 lakh. Profit and loss account, 97,175. Great. This is the money due to them. But we need to close the realization. Take a total. We take a total. It is short by 37,175. This loss belongs to the equity shareholders. 37,175. So to realization account, 37,175. Give them equity shares. Equity shares in LK Limited, 396. And also give them the cash, 64. If everything is right, the two totals will match and it will get closed. It indeed closes. So that is the final settlement of the equity shareholders. It closes the books of L Limited. Realization account. Anything left in the realization account? Pause the video here. This will give you a good view of the realization. LK Limited. Pause here if that is pending. Preference shareholders. Pause the video here. And of course, equity shareholders. Pause the video here. That will complete your solution.